Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, November 8th, 2022. It's 10:51 Eastern Time as I'm starting the video, AM of course. I'm going to go over, in this video I want to really focus on the sectors. Had a member ask to give an update and do some analysis on the sectors of the S&P 500. There's 11 of those. I'm going to get to that in just a minute. And I figured I'd use the beginning of the video to just do updates on some of the recently highlighted trade ideas. Starting here with gold. Gold's really running good today. You had this triple bottom low recently mentioned, 1, 2, 3. Each one slightly lower than the previous, giving us positive divergence at each low. Really one big divergence is like I like to call it, when you have a series of consecutive divergent lows, and you can just extend that divergence line out, and it's starting to play out for some pretty impulsive buying, especially today. We had that flagging type behavior or action there, took it out today. So looking good. This is a 60-minute chart, hourly chart. Little fuzzy on that resistance level. I'm more focused now, and I'm going to get to the daily here in a second, on this being a possible bottom in gold before the next leg up. I've been looking for that for a while, and I'll show you why and what we need to see to firm that case up. Before I leave the futures, let me just show you the silver. Silver tends to run more than gold when it runs. Tends to go in the same direction, and that's up nice. Starting to diverge a little bit. Some divergence here on the 60-minute chart, but really impulsive buying. And then bigger picture. Let's keep in mind bigger picture. If we go to gold, this is a daily chart of gold. Back here in 2020, it hit a major high at that point. Had been pretty much long as a trend position since the lows back in the bottom in 20. It was technically December of 2015. Gold bottomed, and then GDX bottomed shortly after, early 2016, and then gold embarked on a new bull market. But this was a major high right here. Was coincided with the previous bull market high in gold, and at that point, I mentioned closing out all swing and trend positions and short in gold in the miners, and looking and laid out a pullback buy zone, a target zone right here. We hit it several times. We had a couple hits there, followed by a nice rally up right there. Then you came into the zone again a couple times, rallied from there, and also hit that same major high. It's about 194. So this is kind of macro, bigger picture. But then near term, remember, I have my indicators turned off because I wasn't going to cover those when I cover the sectors here in a minute in the S&P 500. But I just wanted to say, which I have been saying, there was positive divergence. So if we can hold today's gain, today's big run up, and especially if we can build on it, this is big to me because I've been waiting for and expecting a recovery back above 158. That's the bottom of that buy zone I laid out a couple of years ago, and we've hit it several times. And say what you want about it, it's hard to argue that was not an important level in gold. You had a lot of reactions both from below before, and then it was key support for years, and just recently that support was broken. So on face value, that's bearish. However, a breakdown of support that has positive divergence and a strong fundamental case, I believe, for gold, those have the potential to be a false breakdown, and that's one of the most bullish things in investing and trading and technical analysis, is when you have a failed bearish setup or a breakdown, because that becomes then a bear trap. That means two things happen: shorts pile in and short gold, and then the weak-handed longs get shaken out, and then that just gives you a stronger pool of holders. Anybody that's been a gold bug or a holder of gold for whatever reason, whether use that label gold bug or not, you've just been bullish and it's been part of your portfolio. If you didn't get shaken out here, why in the heck are you going to sell here? So that's what that means by a stronger pool of holders on the longs, the long-term investors. So if gold can hold this breakout, especially build on it, yeah, there'll be plenty of zigs and zags along the way, but I think that's going to be the catalyst to run back up and challenge those previous highs. So from a technical perspective, that's everything I just spoke to. From a fundamental perspective, somehow gold and silver didn't get the memo that we're in a hyperinflationary environment. You have everything that comes out of the ground pretty much except gold and silver. I mean, whether it grows in the soil and such as wheat, corn, and soybeans and that kind of stuff, they've been going up. everything else commodity related. But gold and silver, although they're called precious metals, they're also industrial metals. There's tremendous industrial application for both. The cost to mine them, the two biggest components are fuel costs. Obviously, you run the machines. As I said many times, this isn't 1849 anymore, where you can just grab a pan and scrape some gold out of a river in Sacramento. That's long since the earth has long been stripped of its surface gold, so you got to go deeper and deeper. That's very energy intensive. You have energy prices soaring, which is a big component cost, so that should drive the price up for gold. But again, it's just not responding to that. Plus, it's been in the past a great inflationary hedge. And so for the fundamental reasons, and of course labor, that's the other component. The miners, they've got machines, but they get people running the machines and working, and so labor costs are going up. So there's just a whole big case to make the, a fundamental case that gold should be considerably higher than it is now. And so anywho, technically and fundamentally, it still looks good. And like I said, if you gotta hold this, that could be a little whipsaw, maybe on a weekly closing basis. You fail to get above 158, but that's what you want to see: a solid daily close. Even better to see a solid weekly close. And the farther you get away from 158, the lesser the chance that it's going to be that this was a whipsaw and just a back test and we're going lower. So that's what we'll be watching for. Right now it's looking good, like I said, and the divergences indicate that's the most likely case. So that's gold, silver. That was, I already showed you the 60-minute charts of silver and gold. Let me give you an update on cotton. Cotton had, I just before the video I got a fill. I gave that one more rope than I should have, and barely made a profit. It's slightly profitable because I entered it too early. It was thrown out as a trade idea back here somewhere. This is a 2-hour chart, 2-hour candle, 6 months, but you had a nice downtrend line, and you had divergence on the 60-minute chart. That's what these divergent lows were, 60-minute divergences, and well, you could probably see it here as well on the 2-hour chart. But there's pretty good resistance at that's 0.8952 right there. And so that's where I had an order to get out. And like I said, it may continue to run up. When I first laid it out, I showed you that cotton has a history of either full throttle up or full throttle down. It's either doing one of the two with very, very few periods of consolidation. I mean, you can even see it here on the 6-month chart. It's either going down or it's going up. And when it goes up, the uptrends are pretty powerful. They're usually well into the double digits, and likewise, so are the downtrends. And again, we're in an inflationary environment. Buy commodities, buy on the dip. So it may have more upside, but you're coming up to that resistance, and when you zoom down to a 60-minute chart, you can see this divergence starting to form here. Indicators are lagging. It may have a little more upside, but also if you want to ride it, nothing wrong with trailing a stop up. Just have a stop somewhat below that trend line. That break of this uptrend line will probably bring in some selling, and then maybe recycle back in if we do get a decent pullback. But again, this sucker is trendy. It's either usually going up or down. Even in the downs and ups, there's those pullbacks. That's why I said I would look to re-enter if it gets a pullback there. And before we get into the sectors, let me do updates on the 2 trade ideas I gave you today. And this will segue into what I'm going to cover in the video, the rest on these sectors on the S&P 500. I provide 2 types of analysis, generally speaking, on the right side of the chart. Actionable, what I call actionable and timely analysis. For example, the first trade idea I got out to you this morning was ZB, the Treasury Bond Futures, and that was actionable and timely because I said it was, I had such confidence in the wedge breakout that I said that one I think you could go ahead and take a starter position before the breakout in anticipation and add on a break of 119.032. That's your more conventional entry. So there's a breakout. It's impulsive. So I'm starting to see that return back to these risk-off, formerly risk-off assets that used to go up when the market went down, such as gold and treasuries. So you have both rallying today. And so this one was actionable and timely, and it broke out, and so that should open the door to T1. Now, once you break out, you may run up there, or you may pull back. If you pull back, then if you miss it, you'd get an objective entry on a back test of that 119.032 and or the trend line. And you could have a stop if you want to keep a tight stop somewhere inside the wedge, because it should have no business going back in the wedge. It would be a failed breakout. Now, if it is, and we make another low, if it's a divergent low and we set up again, maybe challenge. Well, we already tested those previous lows, but it may be another setup. As of now, it looks good, and whether you have a pullback or you hit T1 then pull back, it's probably looking something like this. Go up and hit T2 after T1 zone gets taken out, pull back, maybe hit that trend line, and then run up to T3. And right now, that's what this swing trade has a good chance of hitting. I wouldn't lay out 3 distinct targets if I didn't think they all had a good chance of being hit. Obviously, the way it works is this one has a better chance of being hit than this, which has a better chance of being hit than that. And then after that, we'll kind of regroup and see if it does pan out. So that one was actionable. And the other one was, it's not actionable as of yet, was NQ. I gave you both ES and NQ, the S&P 500 futures and NASDAQ 100 futures. I showed you these small bearish rising wedges on the 60-minute chart. That's what we're looking at. And so this morning, since that was supposed to be pulled back and made a perfect test of the uptrend line, and the buyer stepped in. So it's still timely to get that out to you, but it didn't break out yet. It's not actionable yet. That one you'll want to see, because we were so close. There was no real benefit to taking now you could take a short here, because now we're back to that 11,101 resistance right there. So you can either short at the top of the wedge, which is also more importantly price resistance. This upper line is more of a divergence line anyways. It shows you the wedge line. We started to diverge at the tail end of the wedge here, right by the apex, and so you could take a shot there now, and or when a break of the wedge. And I'd say at minimum coming back here to that 10,901. I think I listed that as a minimum pullback target, and potentially more. We'll see. And if we carry on through here and we don't break down and this trend line stays intact, well, you've got a bigger, longer term, more significant trend line coming in. I'll zoom out a little so you can see it here, right here. So that would be the next resistance level right there. And as I said, bullish if that gets taken out. But there's that small wedge we were just zoomed in on. So that's that. And then ES was the same thing. ES is the S&P 500. And I said, obviously, if you want to increase the odds, you're going to short either one. You want to see them both break down, and they both pulled right back to their uptrend lines, and so the wedges are still very much intact without a sell signal there. Okay, dokie. Let's roll into the sectors of the S&P 500. So what I'm going to show you here, I'm going to start with the S&P 500. The S&P 500, of course, being much more diversified than the NASDAQ 100. NASDAQ 100 is 50% tech stocks. It lacks financials, so it's really a concentrated play on the tech sector and the big market-leading FANGs. Whereas the S&P 500 is more representative of the overall stock market or the overall economy as well, because of its diversity, especially among the 11 sectors that it has. But the point of this video, what I wanted to show you here, is we're going to do a that was then, this is now kind of thing here. All right, so that was then. So here we are. I'm going to go to board number 5. Let's do board number 5. Let's turn on one indicator. Let me show you the PPO. PPO is a close cousin to the MACD. Let me make sure. Oh, there's. I'm not on the weekly chart. I wonder. Okay, so we're going to go to weekly. Here we go. All right, so I'm going to start out by just reiterating what the bigger picture is. This is very important and very much germane to what I'm about to cover in these sectors with these Fibonacci retracement levels. Down below here, I'll expand it for you, you can see a very simple but very effective indicator. It's the PPO, again, close cousin to the MACD. Some charting programs don't have a PPO. Don't ask me why. This one just responds better. It does a better job overall, especially when looking over long periods of time. You put a MACD, you're not going to see these distinct trends or movements and separation in the MACD as you will in the PPO. It's also better used on securities with high price ranges from high to low, and that's why when you go back long term, when you're going back 10 years or more, you'll see if you compare the two, PPO is just much cleaner to look at. You can see the separation and the divergences that you can't pick up in the MACD. But super simple, you know me, I have some fairly complex indicators, some different moving parts, and then I like these super simple ones. There's a zero line on the PPO just like the MACD, and although it sounds super simple, one trend indicator is if you're above or below it. And I like to use the white line because it's the last of the two to cross. It's a signal line. The blue line is the PPO line. And so you get fewer whipsaws if you wait for a solid cross there. And so basically when the white line crosses down below and is below, you're in a bear trend. I'm sorry, I've got these. Well, I could take those off. No, I'm going to leave the fibs up. But you can see here, and just so you cross there. It doesn't look like a lot, but that was the worst bear market in many decades. One of the worst in history right there, back from 2007 of October of '07 into the March '09 lows. It was a 55+% drop in both the S&P 500 and the Nasdaq 100. So, and it told you throughout nearly all of that. It didn't get you out exactly at the top, but not far after, and it didn't get you in exactly at the bottom, just a few months lag. But it said get out of your 401k, be a bear, short, or go to cash if you don't know how to short. And it would have saved you all that. And we had a couple big, this was a 20% or so drop along the way, and it caught that. There was another, that was 2 years of sideways to down with near 20% corrections in the S&P, and they were every bit of 20% or more, those two drops in the other sectors and other indexes. And so it would have been just a nice time to sidestep, to get out, or even be short, and it caught almost all of that. Then you had the big fourth quarter drop of 2018. You had a bear market in several indexes and many sectors, near bear markets in the indexes, and it told you there, be out. And then COVID hit, it went down, it said you're in a bear market, bear trend. But when COVID was over, quickly said get back in, bullish cross. So where am I going? This indicator is not even close to saying that we're out of a bear market. Now, again, the thing about these indicators, it's not, by the time this crosses over and tells you you're in a bull market, the bottom's going to be in. So I'm going to have to, it's important I say that. You can't use this as an exact timing indicator. That's where we zero down to what I'm about to do in this video and look at things like Fibonacci retracements and divergences and other things that might indicate, hey, this is probably going to cross soon. But right now, it would take a heck of a run to even get us back to the zero line. So by this metric, and one of my other favorites, so super simple but effective, turn off every single line here, and it's that 20-month exponential moving average. Look at your monthly candles. It's this dashed blue line right here. I'm using purple, but it's the dashed blue line, and you can see we got a sell signal here with a solid monthly close below, and every single month since, for the first 3 months, we back tested, failed, stayed below it on a monthly closing basis, and we're still well below it. The only other time we had a close below was back when COVID hit, fourth quarter drop of 2018. And then look, those were bear markets, and they were over before you knew it, or technically, not by my metric, but by the old 20% drop from high to low rule. And then, but it did say, even if you got out of your 401k, it told you next month to get back in, right? And so forth and so on. So it's done a great job, and it got you out of almost all of the bear market back in 2007. Said get out right here. It back tested there. It said if you missed the short, you had another couple opportunities there. Then the bottom fell out of that market, and then in early or mid '09, not at the bottom, it was an explosive move off the bottom, but it said, hey, get back in, the bear market's over. And then we had all these pullbacks to it. Same thing with the previous one before that, 2000 to 2002. Said get out, you just lost the 20-month exponential moving average, which had done a bang-up job throughout the entire bull run, one of the biggest bull markets in history. And then it said, hey guys, party's over, get out or get short. And every time it back tested, short, get out of your longs if you didn't before. And then finally it was over, and it said new bull market right here. So okay, I just made the case on two very simple but pretty darn effective indicators, and there's others out there. We're in a bear market. So the rest of the video, we'll just do this relatively quickly. We're just going to go under that assumption that we're in a bear market, and then what's going to start to change that, other than these longer term indicators, that if you hold your shorts till they flip back, you're going to have given back most of your profits from the bear market. So just keep that in mind. Okay, we're going to go back. We're going to just focus on a weekly chart. I'm going to park this indicator out of the way. We don't need it anymore. We're just going to look at something simple but yet highly effective, and those are Fibonacci retracements. Now, I will say, and I've pointed out recently, there's a lot of fib clusters going on right now. Fib cluster, you want to use your Fibonacci measurements on a trend. You want to capture, for example, on a downtrend, you look at the high, the peak high. That's when the bear market started, into the most recent lows. So these are your fibs they lay out. They show on the left of my chart: 23.6, 38.2, 50, and 61.8. This is my typical bounce back range, or I'm sorry, from 38.2 up to 61.8. That's a typical counter trend rally in a bear market, or a primary, or a downtrend. Whether it's on a very short term, like a 60-minute chart you can use, or even a shorter term, or a long term here. We're looking weekly. We're looking at the bear market here. And then you can also add fibs. If you take a previous reaction high like this down to the recent low, you're going to see, I'd have to color it different so you can see it stand out from the rest, but we'll make it red, or we'll make it purple. I think that purple color stands out pretty good on this chart. And now you can see, for example, right there, from this most recent major reaction high mid-August, as I've pointed out recently, down to the bear market low so far, we had a perfect two different weeks where we ran right into the 50% Fibonacci retracement. But you can see above that here, there's two. You have that purple line overlapping the white line. So you have a fib cluster. It's the 38.2 of the entire move down from the bear market high, and that's right up here, along with the 50% retracement of this move down here to low. They come in perfectly together. That's why you can't even see the numbers, because they're overlapping. And guess where they also come in? The 200-day moving averages, which are falling. 200 days are a little bit of it now, but remember, these are moving down because we're in a downtrend. Prices can move up. These guys will start to roll up, but they're going to come down. It's almost going to be a perfect a tag, if you will. Those moving averages are going to come in right around where that fib cluster does. So, and that was and has been, since the divergent low here, my max bounce target. And where I'm going with this, if it's hit, let's just take this one off. Let's just speak the bigger picture here. Let's talk the big picture being the primary trend, the bear market that we're in now. If those 200s are hit, it's going to be a minimum. Again, in my book, there's, like I say, the fib folks, well, it's not folks, this is math that goes back over 1,000 years. But the minimum retracement level is typically viewed as a 23.6, like I said. But for me, most of the counter trend rallies I look for move up to the 38.2 to 618. So where I'm going with that is that would just be a run-of-the-mill counter trend rally. And I say this because I know in the comments that, actually I think it was a member that asked me to do this video, said, missed a lot of bull runs in a lot of sectors. And I'm going through this as I do this video. Remember, those right now, they're nothing more, and I'm going to show you that here in a second, than simple counter trend rallies. And if you subscribe to that theory that we're in a larger bear market, these are the areas you want to look to add short interest or close out your longs on rallies back, counter trend rallies into resistance levels, including but not limited to Fibonacci resistance or retracements, I should say. Key moving averages like the 200-day moving averages there, and of course price resistance and downtrend lines as well. So you've got them all to look at, and they all come in together. Here's my downtrend line on the S&P 500 off the highs. It's a nice downtrend line so far because you have three distinct highs, 1, 2, 3, and look where that's going to come in if we happen to zigzag our way up here in the coming weeks. It's going to come in with that fib, with the 200 days and the trend line, depending if and when we get there. And so that's it. So we're going to just, going forward, I'm going to click on the sectors of the S&P 500. Remember, right now, as of now, we've only retraced that bare minimum, 23.6. That's where we're actually, we retraced a little more than that. So far, the S&P stopped between the 38.2 and the 23.6 fib. I wish I could make these numbers bigger. That's a limitation, this charting software, but then I'll just read them out to you. So that's where we're at, and right now we're on the 23.6. So just so far, as impressive as this rally may seem to some of you, and as a swing trade, I'll take it all day long, but it's just a run-of-the-mill counter trend bounce within a larger trend. And so that was then. I'm sorry, this is now. Now we go to that instead. So here's the S&P 500. This is what I'll be doing throughout the video. I'm going to toggle back. You can see right here the year breaks. This is the beginning of 2007. The bear market back then began, or the bull market ended, and the bear market began in around first or second week of October. So we'll call it early to mid-October of '07 right there. That was the all-time high in both the S&P and the NASDAQ 100. And then they fell, and they had this major reaction low, which was also, and this is something I've covered in the past here, we had not only that, but we had that divergent low, the same type of, at the same point with about the same distance in time, roughly the same drop in the market. We had a nice positive divergence both on the PPO and RSI, which is not shown here. I've covered this many times. It started to play out for a similar rally, and then all of a sudden that rally got sold into and the market went down hard. So that's the analog. Like I said, this bear market's going to be a lot different from that one. I don't expect things to continue to play out so similar, but again, it's possible, and that's why we do this video. But the point of this one was more so to point out, okay, back then, here's the S&P top. So I measured these retracements down. We had at that low, which was also, again, a divergent low, and the rally there, we had a retracement. You can see it here, just above the 23.6 also. So in fact, almost exactly what I just covered where we are today. The peak was between the 23.6 to the 38.2, okay, 38.2%. That's the 38.2 line. There's the 23.6. And here, I'll tighten it up a little more for you so you can see in the video. We can do that. Certainly, if I can grab, let me park that PPO out of the way. That'll give us more screen to use. And there we go. So there it is. You can see it now a little bit better. Textbook. That was then. This is now. Same thing. Okay. Now we're going to go to the other sectors, and I'll do this a little quicker now that you know what I'm doing. I'm going to start with that. It's then. Here's 2008, and again, all I'm doing is measuring up to a comparable point, which was that mid-July low back then. It was roughly 9.2 months into that bear market, and so you can see the retracements. The biggest sector in the S&P 500 is technology, and that carries, last I checked, about a 25% weighting, so by far the biggest sector. Back then, in 2008, it peaked along with the market back in October. You had, and what I'm doing, I have to do this way. This one was a little bit different. It had its first major reaction low before the bottom fell out earlier than the rest. Tech started, and just like this current bear market, tech led that one down first. You can see tech usually has the most hot air in it. It drives the market up on the upside, and then we had a low in January, a big spike down, and then XLK, the tech sector, retraced right at that 61.8. So again, a typical run-of-the-mill counter-trend rally. If you were in it, trading it as a swing trader, you would have welcomed it. You know, it was almost a 30% run, 29% from that low to high. But again, bigger picture, it was all part of a counter-trend bounce in a drop that was 55% before it was all said and done. And so again, I'm just showing you that these Fibonacci's, say what you want about them, but it's amazing how well they work, and they help you identify if you're looking at just a rally or start of a new uptrend. Because when does that occur? Again, it's not set in stone, but when you start seeing a lot of these sectors take out that 61.8% fib, again, that's where the counter trend rallies are usually capped. Then you can start saying, hey, we may be into a new bull market here with a lot more upside to come, many months, if not years of gains ahead of us. Other than that, we look for these rallies to short into in a bear trend. So that was then. This is now. XLK peaked right here with the S&P 500 back in January, right in about the beginning of the year. You can see my year break lines down there. And recently put in a bottom with the market, and recently rallied to a pitiful. Tech's been lagging. It only managed to get about a 23.6% retracement so far. So still very much within just a counter trend rally. You still have some key fibs ahead. You have the 38.2, and that comes in with these moving averages, which again would be my max bounce target to keep that bear market scenario alive, which is still where I believe we are. Bigger picture, we're just trying to nail down the near term here. XLK. Next up is XLV. Let's go to the then. Okay, back in 2008, the last bear market, healthcare held out. It didn't peak until December, mid-December, so I measured from that point, and it bottomed in mid-July, like the market had that major bottom right there, and so I measured the counter trend rally right here, again from the all-time bull market highs to that comparable mid-June bear market low, and you can see right to the button 50% Fibonacci retracement right there, a run-of-the-mill fib retracement. So that was then. This is now. Healthcare, just like then, peaked after. It's more of a defensive sector. So this is the January. This is when the S&P 500 peaked. Healthcare went on, continued to rally, put in its high in April of this year, and put in its first major reaction low right here. So I'm gonna have to use that because this one we didn't go down as much as the market. We made a higher low, and from that point it retraced right to, and many times, that 61.8% fib. It capped it here, and just capped it last week. So again, right now, and all this starts to change. It's not a all or none thing. If XLV takes out the 61.8 fib, oh, we're in a new bull market. But I'm showing you that at this point, it's just amazing how many sectors are responding so well to these fibs. And at this point, like I said, in healthcare, it's nothing more than a counter trend rally. It starts to become more than that above there, and would certainly be more if it took out the previous highs. But as of now, if the market takes another leg down soon, then that would be similar to what we saw back then. Next up is financials. So let's go back to the '07. This really led the bear market. That last bear market was much more about the financials. The banks would have failed if the government didn't step in and bail them out. They had their hands too deep in the cookie jar, shoveling bad loans out to anybody that could fog a mirror. But there's the peak, which was in 2007. Banking sector topped earlier before the market. A lot like QQQ topped before the S&P 500 this time around. This time it's been more of a tech problem. They had a major reaction low, just like the rest of the stock market back here in around was that mid-July of '08, and had a counter trend rally from that point, measured from the high to low, almost to the button, right at the 38.2 Fibonacci retracement, as well as the 200-day moving averages. And then from there, financials never looked back. They had that 38 run-of-the-mill fib retracement with another 76% downside to come. And I'm sure it felt bullish to be in the financials then, because you had a rally of 47.5%. Remember, there was a lot of movement in that sector because of the problems in the banking system, and then Lehman and Bear Stearns, here and all that good stuff. XLC, I cannot do I'm sorry, I have to go back, and that was then on XLF. This is now. Banks are in better shape than back then due to a lot of the regulations that were put in place because of that financial crisis back in '08. But you can see here, the banks peaked right with the stock market in the beginning of the year, right there. You measure down to the recent lows. They bottomed with the stock market recently, and as impressive as the rally has been, it's nothing more than a run-of-the-mill minimum 38.2 Fibonacci retracement so far, right back to their 200-day moving averages. So that's where we are now. Again, just a run-of-the-mill counter trend rally, as impressive as it may feel. And yeah, sure, maybe a little more upside, but unless we start taking out these 61.8s, and especially the important sectors more so, the ones that move the needle. I'm going through this as I do these charts. I'm going in order of weighting in the S&P 500. So XLK by far the heaviest weighting, then XLV healthcare, then XLF, and down the line here. Next up, I can't give you XLC back then because it didn't exist. They did have 11 sectors in the S&P, but it used to be XLT, the telecom sector ETF, and they realized that telecom's kind of an antiquated thing, Ma Bell, AT&T, and all that. So they still have those AT&T and the Verizons of the world, but they're now considered in this. They revamped it to call it the communication sector. So XLC didn't exist back then. We don't have any type of tracking ETF or anything. So I have to just look at it right now and tell you that the communication sector peaked earlier in the year with the S&P 5, or I'm sorry, with the Nasdaq 100. Recently bottomed right here, and so far, I mean, hasn't even had a hiccup so far for a counter trend rally. This one's getting pounded due to, I think it's Facebook, and a couple of the big fangs really weight this one down. So we don't even have really hardly any kind of retracement yet. XLY is next up. Let's do that. That was then 2007 right here. It peaked right at this point. That was a little before the market. So this one peaked back in the summer around June. Consumer discretionary, and it did bottom with the rest of the market in what was that in July or so back there of '08, and had a counter trend rally that took us. Really, most of it was capped right here at the 38.2. There was a little spike candle. I don't know if that's an errant candle and wrong print right there. Even if it was, it only spiked. It was an intra-week spike that failed between the 50 and the 61.8, and then of course the bottom fell out from there. So far, I'm just showing you all these sectors, just like then. This is now. We peaked in November. Looks like November of last year. Moved down. We bottomed the bottom so far in the consumer discretionary sector. This one, Amazon's the biggest component of that one, and just like Amazon had a major bottom right there and a rally, and you can see. So I have to use that to be true to the fibs. I have to use the high and the low, and so it was that June low, and look, rallied right into the 50% retracement, and we're back down to where we were. So, and also those 200-day moving averages. So. Again, another one that only time will tell if this is a double bottom. We're going to do this, but as of now, with the primary trend being bearish, it says that was probably it for the counter trend rally, and there's more downside coming. XLY, no XLI. These are the industrials, and back then in 2007, peaked with the market right around that time. Came down, also had the same major bottom reaction low in July of '08, and went up to the button, almost to the button, the 38.2. Just a run-of-the-mill off the, again, all-time highs to the first, that bear market low at that point in time when the indexes bottomed, all rallied about 38% right back to their 200 days, and then the bottom fell out. And that was then. This is now. XLI also bottomed around with the market, did a double top just like the Nasdaq pretty much, peaking 1st November, then again had a slightly higher high. Let me make sure. Yeah, I am using that one. That's the one I'm using. That was the high with the market right there in the beginning of the year, and right when 2022 kicked off. There was our recent low right here. That was with the stock market there, and so far we're right between the 50% and 61.8 fib, and so as of now, nothing more than a counter trend rally. As of now, clearly still in a downtrend. A downtrend is simply defined as a security making a series of lower highs and lower lows. So what happens if we keep going up? Well, you take out the 61.8. It's a little atypical for a counter trend rally. Doesn't mean that we must go to new highs. And then obviously if you take out that previous high, then that also brings in this downtrend into question and starts to increase the odds that we may run up and maybe the bear market's over, at least in XLI. Okay, we're almost done. Also keep in mind, as I get down the line here, these sectors have a lower and lower weighting, meaning less of an impact on the stock market. This is XLP, consumer staples. This one was a little wonky. It peaked with the market back there in late '07, had a major bottom earlier in the beginning of '08, and then made a full retracement and then some, so 100% retracement. Then the bottom fell out of that one, so that one was a little bit different. Now there's the high right there. This one carried all the way through into April before it topped. So it peaked after the stock market, but bottomed with it recently, and so far rallying between the 38.2 to 50% fib there. XLE, this is interesting because back then, let me go back to 2007, XLE was a holdout. Remember, the stock market and just about every other sector bottomed in October or November, late '07. And crude oil continued to soar. I remember that. Crude oil prices peaked out at 150 a barrel. Energy sector continued to rock. And then finally, demand destruction set in. Once the market realized the recession was in full swing and we were heading into recession, energy sector gave up the ghost, rallied down into the same October, or no, it was actually July. It was a little later, October low, and then had a 23.6% retracement before the next leg down there. So XLE, like then, now it's a different animal. It peaked here initially, and it didn't peak with the market and kept going up and started to fall, and now we've made 100% retracement since the peak. So XLE is kind of doing what it was back then. Energy and crude oil has been held up, and we'll probably see the same thing regardless of what's going on over with Russia and Ukraine and those problems. Sooner or later, we'll start to see demand destruction set in, and so I think like then, crude will be a late bear market short, the sector to be on, and when it plays a game of catch up to the downside. But right now, energy is still right there at the previous bear market high, or bull market high, I should say. And the rest really don't matter as much. You go down to XLU. Utilities aren't going to move the needle. Back in '08, peaked with the market right there in November, December. Had a double bottom there, retraced right. The point is, these retracements, they were bear market rallies. They ranged from, in some cases I showed you as low as a 23 point, whatever that was, 23.6, all the way up to the 61.8 with few exceptions, and then the bottom came. So that's what we're looking at. And XLRE didn't exist back then. I'm going to get to that one in a second, but there's XLU now. XLU, the utilities, they carried all the way up here until recently. This was the peak in, what was that, late August? No, September. But then finally playing a game of catch up. This is what happens. I'm going to do another video soon to show you the strong stocks. There's a lot of strong stocks out there, particularly in the Dow and the S&P, that are not far off their all-time or bull market highs. And I'm going to go over those charts and tell you what I think the next phase in the markets are going to be based on those charts. Tech led the way down this time around, just like it did back in '08, but then other sectors started to play catch up. And XLU, just want to point out, as of now, has retraced the 38.2% retracement, stopped there and pulled back. So that's it. Run-of-the-mill corrections. XLRE, you have to use IYR back then instead, because XLRE, I just like to use these spiders because they're run by the S&P 500, so I believe they're more accurate representation of the 11 sectors that the S&P 500 uses. But IYR is run by a different company, so you're going to have a different basket of REITs. But if you go back into that previous bear market, you can see here it topped there, had the same bottom in July that the markets did. It rallied back between the 23.6 to the up to the 38.2, and then the bottom fell out of it. And then the only other sector there left is basic materials. Again, doesn't move the needle much. It's about a 3% weighting or less in the S&P 500, but peaked right here last time around, in 2008. So it carried longer. The rest of the stock market peaked there. Basic materials held up. Peaked in about the second quarter of '08. Went down, had a rally up right up to the 38.2 fib. Was nice support. You can see a triple bottom there, rallied up, but then boom, once that support broke after that 38.2, run-of-the-mill bear market retracement, next leg down, and that was then. This is now. We peaked with the market this time around, almost had an equal high right there, held up, but just like then, so basic materials pretty much held up, but I'll be technically accurate, and I'll use that previous high right there, measure down to the recent lows with the stock market, and so far we're between the 38.2 and the 50% retracement, and so by just about every metric I just showed you as of now, this rally, and it has plenty of upside if it wants to. Meaning you could, plenty of room to go before you hit 50 and even 61.8 retracement levels. You have a lot of key moving averages, but some sectors have already done that and started to reverse. So, like I said, as of now, I'm going to view this as a bear market, bigger picture, and so I'll be looking for objective areas to get out of longs and/or get back into shorts for trend positions, and then go for the next leg down, or if the charts start taking out these levels, start taking out the 200-day moving averages, take them out on a daily basis, more so on a weekly basis on the 200 days. It's common to have them taken out on a intra-week basis. I like to see them go on a weekly closing basis. The downtrend lines, like I showed you in the S&P 500 and many other sectors, you can put some nice clean downtrend lines. 200 days, those start going, then that chips away at the bearish case. These Fibonacci's start going, especially that 61.8, it's even further going to chip away at it. Doesn't eliminate it, until you make new highs. It could just be a big counter trend rally, maybe to the next fib, which is right here, 78.6. I didn't put them up. Sometimes you retrace that much. I'm just talking generally, and that's the point of this video. So hopefully it wasn't too repetitive, but just trying to show you big picture. And I will in another video, this one will get too long. This might not have been the exact type of analysis that a member was asking for, but in another video or static charts that I'll post on the site, I'll highlight some of the technical postures other than just the fibs, because that's all I focused on here, of some of these sectors such as financials, for example. If I go to my other board without the fibs, you can see just like the S&P 500, financials have a downtrend line off the highs. That's the way I have it right now because it comes in on these 1, 2, 3 highs. But if I wanted to, I could probably drag it down a little and say that we may be closer to it right now. We're also right at the 200-day moving averages, and then big. I had a red line here before at 35.33 because to me that was major support right there. Was that first target from a short trade back here. We pushed up, continued to diverge, went down, and we took it out. And that was a big sell signal to me in the financials. Then we hit my second target and bounced, went back to the first target, former support, then becomes resistance, had another rejection right down, hit my third and final target there, bounced back, got rejected again off that level, had an even deeper sell-off, put in positive divergence, which has carried us so far back to that level. So if we're in a bear market, there's a confluence of major resistance here in XLF in some of the stronger sectors right now. So I can easily see a little more upside. But nor would it surprise me that any point out of the blue, because that's the character and the nature of a bear market, if all of a sudden, just as the masses start to think, oh, midterms coming up, and we went through earnings season, and yeah, some of the fangs got beat up pretty good, but overall, earnings were held up pretty well. A lot of companies even had good earnings because they were able to pass along prices to consumers, blah, blah, blah. That's kind of the fundamental, those two things right now, the fundamental component. The technicals are what I mentioned, the divergent lows on the daily and weekly charts and 60-minute charts. That was the technical catalyst for the rally we're in now. The fundamental is what I just said, midterms, typically perceived as bullish for the market if the Republicans sweep the House and even or get control of the Senate. And so I think there's a little hopium going there. And like I said, earnings season wasn't as bad overall. There were some companies that really took it on the chin and some that didn't. So but how much of that's priced in? And again, if it's a bear market, then technicals will be our guide. So that I see in a lot of these sectors limited upside from here. And but the thing is, just sit back, be patient, and use these 60-minute charts like that. What I started the video and the little bearish rising wedges and SPY and QQQ, and that should get us short for the next leg down. So we take these. Remember, that wasn't resistance. This is just our divergence line. There's our most recent divergence taken out now, and we're coming up on that downtrend line. That's big resistance, these downtrend lines overhead. Okay, long video. I'm going to wrap it up here and start looking for some new trade ideas for you. This has been Randy Finney with Right Side of the Chart. Have a great day.